Now, another term that you run into in capital budgeting now is a term called working capital. Now, working capital was something we talked about when we went through financial ratios, and it's defined as current assets minus current liabilities. And in that lecture, I told you that the greater the working capital, the greater the liquidity of the company, and the greater the firm's ability to meet its short-term indebtedness. And all that's true in a financial ratio sort of way. But working capital has another meaning to it now. And in capital budgeting, an important thing to look at. Let's look at a balance sheet here. Now, on the left-hand side, we have current assets, fixed assets, which gives us total assets. On the right-hand side, we have current liabilities, long-term debt, preferred stock, common stock, retained earnings. And it all adds up to total liabilities and owner's equity. And you recall that these things always have to be equal because you have to pay for the assets that you buy. Now, if you look on the right-hand side of the balance sheet over here, there's something called the capital structure of a firm. You hear that a lot, you hear that term a lot. Now, the capital structure, the word capital again, denotes something long-term in nature. In this case, the capital structure of the firm is the entire right-hand side of the balance sheet less current liabilities. That's the capital structure. That's the long-term financing of the company. Those are all the things that we talked about when we went through cost of capital. Now, if we were going to, double the size of our business, we make blue shirts. And instead of making, 10,000 blue shirts, we're not going to make 20,000 blue shirts. So we're going to have to invest in things so that we can do that. One of the things that you're going to have to invest in when you buy a new asset or you expand your business down is what's known as working capital. Now, if we were going to sell twice as many blue shirts, we would need more cash. We would need more cash because we're going to have to pay our employees more. If this is a retail business, we're going to have to make change, all that kind of stuff. So one thing we're going to need is more cash. If we're going to sell twice as many blue shirts, we're probably going to have to finance twice as much of our sales. That is, our receivables are going to go up. And that's something we have to finance. And if we're going to sell twice as many blue shirts, we have to buy twice as much material, twice as much blue dye, all that kind of stuff. And our inventory of one sort or another, raw materials, work in process, finished goods, all of that's going to have to go way up. And again, these are all current assets. Those are going to add up, we estimate, we're going to have to invest another $600 in current assets in order to sell twice as many blue shirts. In a normative sense, the way things should be done, you should finance current assets with current liabilities. In a normative sense, you match the life of the assets with the maturity of the debt. So a current asset, a short-term asset, should be financed with what? A short-term liability. If our current assets were going to go up, what we'd really like is for our creditors over here to give us $600 more. They don't usually do that. So if it only went up $200, we would have to calculate the change in working capital. Now, it's the change in working capital, that term, that you commonly see in capital budgeting. And in this case, the change in working capital is going to be $400. The difference between this $600 and this $200. That's the change in working capital. What does that mean? If the change in working capital from doubling our business, from selling to sell twice as many blue shirts, if the change in working capital is $400, that means we're going to have to go out and raise that $400 through the capital structure of the firm. We're going to have to sell debt, preferred, or equity of some sort and come up with that $400. And what do we have to do with that $400? Well, we have to invest it into current assets. In this case, cash, receivables, and inventory. If you don't do that, you won't have enough cash, receivables, or inventory to sell twice as many blue shirts. Inventory, for instance, you can't sell from an empty cart. If you don't have twice as many blue shirts to sell, you can't sell twice as many blue shirts. So what you have here now with working capital, the change in working capital, this is money that you would have to invest today in order to invest in the assets that will double the sale of our blue shirts. Financially now, what you're doing is you're raising money in the capital structure to finance this working capital. You're taking that money now and investing it in current assets. Those tend to be low return assets. What you'd really like to do with capital money, long-term money, is invest in long-term assets, fixed assets, higher return assets. So when we say that we have to invest in working capital, that means there's a mismatch here. That means we're financing short-term assets with long-term financing. That's not usually a good thing to do, okay? So though we looked at working capital as being this positive thing about being able to pay off our short-term debt, in a capital budgeting sense, not so good. The change in working capital, this $400 in this case now, this would be in addition to the present value of the outflows, in addition to the initial investment. This is money that you have to invest today, or the results that you're wanting to get won't be achieved. You have to put the current assets in place to finance a company. Most companies that get in trouble when they grow fast is not because they don't finance their fixed assets. I mean, they get the blue shirt making machine in place and they pay for that, but they fail to finance their current assets. That's usually what leads to trouble in fast-growing companies. And this is called working capital. In capital budgeting now, what you're really after now is what's called the change in working capital.